Hi, this is John Edson. I'm a principal with Smith Schaefer and Associates, and I lead our business valuation department. And today we're going to talk about what my business is worth. And we're going to split this into two parts. And the first part is going to be about business valuation background. And then the second part will be business valuation methods. All right, so we're going to talk about valuation methods today, and there are three primary approaches that we consider. The income approach, which includes the capitalization of historic cash flows, and then the present value of future cash flows is the second method we use there, otherwise known as discounted cash flows method. The second method or approach is the market approach, and in that we find comparable transactions or comparable public companies to our subject company that we're valuing. And third, and the least used, is the net asset approach. If you've had an appraisal done of a piece of property, commercial property, you might notice that these three methods or these three approaches are very similar to what's used in the real estate appraisal industry. So here's an example. So we start by determining what the return on investment should be for a business. And we start with the risk-free rate, which is a 20-year treasury rate, and then we add an equity risk premium. And the reason we're doing all this is we're building up from the risk-free rate because an investor has multiple choices. If they want to invest risk-free, they can invest in U.S. Treasuries, and they can get somewhere 3.5–4% on those depending on the length of time. And then if they want to take a little higher risk, they can go into equities. And so that would add another 6% to the return there, so a total of 10%. Then if they invested in small equities, small publicly traded companies, they'd get another 5%. All this information comes from a database that we subscribe to. And then, in the end, we look at company-specific risk. And that's because each company has its own risk, and all these companies that we're typically valuing are smaller than the smallest company on the New York Stock Exchange, which is where the equity premiums come from. So you can see that we might have a low-risk company and we might have a 20% return that we're planning, or if we had a high-risk company, it might be 25%. So the return on investment is determined based on the risk of the investment. So then we figure out the cash flow. So we start with net income and we add back to that depreciation and amortization, income taxes, interest, we subtract capital expenditures, and then we might have some pluses or minuses for normalizing net income. Things like extra perks that a business owner is taking out of the business, unusual items that may have occurred historically, and so on. And so that making those adjustments gets us down to what we call a normalized net cash flow. The market approach, we take comparable companies or transactions and compare those to our subject company and come up with ratios that we apply to that net cash flow or EBITDA. So we use a database. We have several databases that we typically use that have comparable companies in them. And we can find transactions for companies that are of the same industry and similar in size and so on to our subject company, and then compare those, come up with the ratios like a price earnings ratio to value the company. For comparable public companies, we also have a database, and we can go find public companies and compare their price earnings ratios to the company we're valuing and come up with a value that way by taking the public company's price earnings ratio and calculating based on our company's cash flow. So these ratios are all applied to our company. We can compare all these ratios and come up with a value. So this, the next valuation method is the net asset approach. And under that approach, we value all the assets, the balance sheet of the company, and come up with the fair market value, or in some cases, we may come up with the liquidation value of the assets and the liabilities. And so we're valuing each individual asset. So we come up with a value for accounts receivable, for inventory, for the fixed assets of the business, and for the intangible assets of the business, such as goodwill, patents, trademarks, and so on. So this may be utilized when assets have more value than the value generated from cash flow. So this might be a method that would be used in a construction business that had lots of heavy equipment, bulldozers, road graders, and that type of equipment that doesn't lose value very quickly. So what do I want to accomplish? Well, our conclusion is the way to increase the ultimate value of the business is to increase cash flow and reduce risk. And so in our planning for our business, succession planning, planning for a sale, these are the two things that we want to focus on, is how to increase our cash flow and how to reduce risk, provide stability for the company. So thank you for visiting with us today. You can contact Smith Schaefer, any of us, in any of our offices through our website. Contact information is available there.